Welcome back, everybody. Good morning. It's August 9th, 2024, and here we are. Still alive, still here, still trading. We'll go over a quick State of the Union real quick, and from there, then we'll just kind of go ahead and dive into today's content with some inverted strangles. To the uninitiated, probably sounds like a murder weapon or like a type of murder, but it's not. Definitely feels like you're being murdered when you're trading it, but it's just because inverted strangles are kind of a last line of defense, and they're not that fun. So let's get into it. Dell. God damn it. I just want this strangle to work. I just need Dell to hold 85 so I can be okay. Looks like we got a mixed bag here. ARM up slightly. The Qs down slightly, but the market just about even. Probably trying to figure out where it wants to go. Doing well in some respects with Palo Alto and CrowdStrike. Not so well with AMD and some of the other guys in the portfolio. So, pretty quiet day, hopefully. With Bitcoin down, I'm hoping that Coinbase will go down a little bit, and we can kind of just roll into a different cycle to reduce our cost basis here and just kind of see what happens. Of course, I would love it if Coinbase got down to about 165 and stayed there, but we will see what happens. Nothing else really on my radar other than just, again, trying to stay small and scale out of this volatility decrease as it goes down. So nothing really in the portfolio that's on my radar at the moment. Got some losers. Of course, we are long the overall market still, so our short positions, if they are profitable, probably signaling a mixed bag in the market. Palo Alto, though, carrying the train here. And like I said before, this 350 call, still $30 out of the money in 14 days to get there, so not at all worried. Palo Alto gets to 350, I'm going to be a very happy man. That's going to be about $3 grand in profit, and we could even roll this guy out if we really wanted to hang on to that option. So, yeah, that's pretty much the portfolio. Looks like a good day overall, all things considered, but I did want to go ahead and go into the content for today, the short inverted strangles. We have a couple on in our portfolio, and I just thought I would go over them because inverted strangles can be such a headache for new traders. And don't get me wrong, they feel awful to trade every time you do them because you're not in a good spot when you put an inverted strangle on. But we'll get into the content for today. I'll go ahead and switch over to the slides. I kind of started the presentation here, but yeah, so today's going to be on managing inverted strangles. Like I said, to some of you who aren't familiar with inverted strangles, it sounds like a really fancy way to murder somebody. It's not what it is. It's a trade strategy. It's a trade defense, really. But just as an introduction, so ideally, if you place a short strangle, which is one out of the money call, one out of the money put, we want the short strangle options to just expire out of the money, right? We want the stock to stay between our two short strikes, and we want to just collect our profit. Sometimes that doesn't always happen, and we need to adjust the position. So as some defenses, we'll first roll the position out in time to collect some credits, and then we'll start rolling the untested side, either to a tighter strangle, where you have both options out of the money, a straddle, where you have one option in the money, and an inverted strangle, where you have both options in the money. So I'll go ahead and kind of walk you through each piece of that and demo this so that you can see what I'm talking about. But first, some pros and cons to inverted strangles. Why do we invert? Why do we put the options in the money instead of just closing the position out? Well, the first thing is that your goal is still the same with an inverted strangle. You still want the stock between the two short strikes, but the inverted strangle will reduce or flatten your deltas, which is your risk, and it maximizes your extrinsic value and gives you more time to be right. The downside is that your max profit is decreased and you have whipsaw risk. So I'll just go ahead and jump into an example here so you can see what I'm talking about. When we unpack what an inverted strangle is, though, it's helpful to understand a normal strangle. So a normal strangle is two options out of the money, right? So this is Dell, and this is a position that I took a few months ago. I added to it, and this is the added leg, the 85 put and 109 call with the stock at about 91. So you can see the stock here at 91 is between our 85 and 109 short strikes, and that's what we want, right? That is a normal, typical strangle where you're obligated to buy a stock at 85 that you don't have, you're obligated to sell a stock at 109 that I don't have, So if both of those obligations end up worthless, right? If Dell ends up anywhere in that range, I'm not going to have to buy the stock at 85 because that insurance is worthless at expiration, and I'm not going to have to sell a stock at 109 because, you know, people can just buy it on the open market for cheaper than that. So with both of those options out of the money at expiration, this is what a normal strangle looks like. This is what we want. And I'll just go ahead and hop into the platform here really quickly to sort of show you how we get to an inverted strangle from here. How does a normal strangle just sort of go sideways? So let's pull up the strangle here in the platform. And I will, I have a couple positions on Dell. I'm going to go ahead and make sure those are off. Good. So we're only seeing the 85.109. And let's say, just pretend for a minute, that Dell is not at 90 and change. Let's say Dell's at $80. Okay, so it's tested our 85 short strike. It's past, and by past I mean below, the 85 short put. Well, what does that mean for us? If we take a look at what the options contract actually means. What does it mean to have a stock below a short put strike price of 85? Well, if you are short an 85 put, that means you are obligated to have shares put to you at 85. That's why they call it a put. So if you're taking on the obligation to have shares put to you at 85, you are taking on an obligation to buy someone's shares at $85. So you own Dell at 85. If Dell's at 80, that's a $5 per share loss, which is $500. That's what we mean by tested, that the stock has moved past your short leg, and that you, from an options contract perspective, now have some intrinsic value to that contract. If I have to buy Dell at 85 and it's at 80, that's bad news for me, and I'm still on the hook for the contract. So, as a defense to that, what we can do to lower our cost basis and shield ourselves, and again, this is just for demonstration purposes, the actual position is fine. Let's see here. Yeah, let's go into this 14-day cycle. So you can see our 85 put here. If Dell was at $80, we could take this 109 short call and move it up. So now we're obligating ourselves to sell Dell we don't have at $99 instead of 109, but we get some credit for that. So we get 97 cents a share, which is $97, and it helps buffer that theoretical max loss from owning a stock, you know, at $85, having the stock at $80 or lower than that. If the stock continued to move against us, we would just drag this short leg all the way up to a short straddle, where the options are at the same strike price, right? You have an 85 short call and an 85 short put. So now, let's just pretend Dell's at $80. We're obligated to buy Dell at 85, which is great. If somebody owns Dell and they get to sell it to us at 85 no matter what, that's the long side, remember? The long side has the right to sell stock at 85 to us, to put it to us at $85. So that's not good. And as a defense to that, we are changing our obligation to sell the stock. Remember, originally we have to sell it at 109. We're yanking that all the way down to 85. So now we're saying, I'll buy stock that I don't have at 85, and I'll also sell stock I don't have at 85. And you're thinking, wait a minute, doesn't that just net you zero? Let's say you had to do that. Well, yes, but we're collecting $7.15 a share for that obligation, so only one of these can be true at a given time. This is a straddle right here. And if the stock continued to move against us, we could invert the straddle into an inverted strangle. So just to kind of back up a little bit, and I know I'm throwing a lot of information at you here, but it's a complex topic. So, and wow, I just realized I still have not changed the slide. I gotta be better about that. I only have one monitor, and you know, I only change the slide so often. So let's back up. So I'll go ahead and just do a quick recap here. So currently, my current position is 85.109. Dell's at $90, so it's between our two short strikes. And if we remember that a short put is the obligation to buy someone else's stock, that person has the obligation to sell it to us. So right now that person can sell it to us at $90, and why the heck would they sell it to us at $85 when they can sell it at $90 and make $5 more? So this $85 put option is worthless to them right now. If Dell goes to 0, then it's suddenly very profitable for that person to sell their stock to us at $85. So that's sort of just understanding the options contract and why having this 85 put in the money is bad for us. If Dell was at, let's say, $80, we would have a $5 intrinsic value on our 85 put, and we could sell an 85 call to hedge against that. If Dell continued to drop to like 60, we could yank this all the way down to 75. So this is still a strangle, right? It's still 2 short options. And it's, with the goal of having the stock between these 2 options here. So if we had an 85 short put and a 75 short call, and Dell was at $80, that would be a perfect scenario. We would be obligated to sell 100 Dell we don't have at 75 and buy it back at 85. Now you're thinking, wait a minute, doesn't that just lose you $1,000 if you have to sell the stock at 75 and buy it at 85? Yes, but we're collecting $15.95 a share, which is $1,500 for this obligation. So we would still be able to profit $5.95 because it would be the difference of the 2 short strikes, our credit received minus that difference. And just for this trade, we could still be profitable more than that. Now, of course, the platform is taking that into consideration. We have a little bit more than $15 collected, so the platform is saying, hey, you could still make $1,600 if Dell ended up anywhere between 75 and 85. Obviously, with Dell at 90, we're not going to do that because we are totally fine where we are, but an inverted strangle you can kind of think of as just another means to, defending a trade. And it's not an ideal scenario because you'd be limiting your profitability of the trade to the difference between the 2 short strikes and the credits you've collected on the trade. So right now we're fine. But I want to show you an example of a trade that's not going well that we have inverted. So this is, way out in time, but I'll show you the inverted strangle we have on the portfolio here. And just because both of these options aren't in the money yet doesn't mean this isn't inverted. It's inverted because our best case scenario is that these options end up in the money. So this is a very painful trade. So we're obligated to buy Dell at 125. I put this trade on to buy Dell at 135 in May. And it's just gone against us since then. You can see here at the end of May, Dell's just going off a cliff. It's gone from, about $170 to now $90. So a pretty big move to the downside. And obviously buying Dell, remember, short puts are short puts are the obligation to buy stock, and the long side of a put has the right to sell stock to us. So somebody has the right to sell stock to me at 135, and Dell's at 90. So that's not good. So I'd been defending this position, I'd been rolling it, I rolled it out in time, picked up more credits, I rolled out in time again and moved the strike down, so now instead of 135, it's 130. I sold a call against that, so I made it into a strangle, started rolling that call down, rolled the call out in time, rolled the call down from 130 to 115, and I could mimic this trade another time, but just understand that these are all defenses, right? And maybe we can view the market state snapshots here. So 725 at 937, Dell is at 112, and I have a 115, 130 on. So that right there is an inverted strangle. But if you imagine right now that Dell is not at $90. Dell's at $90 currently. But let's say that Dell is at 115. Let's say Dell makes a heroic comeback and goes to 115. Well, what are we obligated to do? We're obligated to buy Dell that we don't have at 125 a share and sell Dell we don't have at 110. If Dell's at 115, both of those options are going to be in the money because Dell would be between our two short strikes. So then we would take the difference of these two short strikes, which is approximately 15, 125 minus 10, if I was in 3rd grade, last I checked, is $15. But we've collected $22 here. Actually 20 on this leg of the trade, so 20, 45 minus 15, we could still profit $5 on this trade if Dell is between our two short strikes. Now I know what you're thinking. Dell's not between our two short strikes, right? Dell is way down here. Remember, our best case scenario is that Dell is between these two short strikes. Since Dell isn't between our two short strikes, look what's happening. Our short put is in the money, our short call is out of the money. So, let's fast forward this to expiration, and we'll make sure that that only these options are on, right? Now, the platform thinks that we have a lot more latitude than we actually do because it's basing it off the new trade, but we're basing it on the order chain. So we are obligated to buy someone else's Dell at 125. Not good with Dell at $90. Not good at all. We are also obligated to sell Dell we don't have at 110. Now, you might be thinking, well, doesn't that obligation hurt us? Well, no. I'd be more than happy to sell my Dell at 110 right now. If somebody came to me and said, hey, I'm alongside of your contract, I want you to sell your Dell at 110, I'd be like, great, Dell's at $90, you're buying it from me for $20 more than what the market is paying for me? You idiots, I will happily take your money. Like, I don't know what you're drinking this morning, but yeah, I'll happily sell you my Dell at 110. So nobody in their right mind is going to force me to sell Dell to them at a price higher than what the market is currently paying for it. What all this means for us here is that this 110 option, you can ignore this. It's out of the money. It's not going to matter at expiration. That 125 option, however, will matter very much because I will need to probably buy Dell at 125. Now, here's why I'm so keen on holding on to this position. We have collected a whopping 2045. So, at expiration, this short call here is going to be worth nothing. It is going to go away. It is going to disappear into fairy dust unless Dell gets to 110 or higher. Then somebody would be interested in having me sell my Dell to them at a price lower than, the market. Or, excuse me, they'd be interested in buying my Dell because I'd be selling it to them. So they would buy my Dell from me at a price higher than 110. So, right now, if I just do the math, right, I have an obligation to buy Dell at 125. I've collected $20.45 a share. So I'm really obligated. I have a cost basis to buy Dell at 105 and change. Not exactly. I mean, I took the cents off, but, we're at 125. I have $20 in collected credit, which knocks me down to 105. Dell's at $90. So 105 is only a $1,500 realized loss. I say only, but, Now, here's the other thing. Because we have a cost basis of 105, if I'm actually assigned to these shares, which I probably will be, if somebody decides to exercise that 125 option, then I just have 100 shares at 125, and I'm obligated to give them up at 110. So, all that to say, I'm not going to do anything, even with this far out of the money strangle, because I'm more than happy to own Dell at 105 a share if I can just keep writing calls against it in this high IV environment. A lot of people would close this trade out. I'm not going to. I have a short strangle here that's on the verge of being tested, but we have 14 more days to go, and I can always roll him out in time as well for a hefty 611. Now this is post earnings, which I wouldn't want to do that, but yeah, all that to say, the short strangle here, I'm not too worried about it. Not too worried. It hurts, but I don't mind owning Dell at 125. And actually, my fear now is that Dell's gonna rally past the 125, because with downside exposure, stocks naturally tend to just gravitate up. Dell's a $125 obligation. It's not a $300 stock. and Dell's been punished enough that I think it'll probably rebound. Let's take a look at another example of a strangle in the platform that's inverted. That's a little easier on the eyes and probably a little easier to grasp. So this is an example of an inverted strangle that has actually worked in our favor. And by worked in our favor, I mean that we're slowly just recovering our loss of blood. And this is another trade that I put on where I was just long, and this thing just lawn darted. I got long, like right here. I literally got long at the top. And at 105 or so, yeah, May 31st. So right around the last day that all this stuff started to just go wrong. And this, yeah, VST's just decided to lawn dart since then. So I was obligated to buy it at 87.5. Obviously, with VST at 76 and change, the obligation to buy a stock at a price higher than what it's currently going for is not good. So I started defending, started rolling out in time, put a short call on there, and we end up at the inverted strangle. You can see we had the straddle on at one point, the 87.5, and the trade continued to go against us. If you look at this is the price at which we adjusted the trade each time. So now we're left with a 75.85 inverted strangle, and at first glance, if you look at it, it is between our two short strikes. It is where we want it to be. We are obligated to sell VST we don't have at $75, and we're obligated to buy it at $85. Both of those obligations, if you notice, they have some intrinsic value to them. The person that wants to buy VST from me at $75 is going to be happy. They get it at a price cheaper than the market, because the market is offering it at $76.85, so they're happy to buy it from me at $75. And remember, I don't have VST, but this is counterbalanced by the fact that I'm obligated to buy VST at $85. So I'm gonna buy it at $85 at a price higher than the market, sell it at $75 at a price lower than the market, which is a $10 loss, right? I'm buying at $85, selling at $75, but looky here, I've collected $11.86. Sounded like my grandmother there. She says that all the time. Looky here, you know? So, $11.86 minus 1,000 is $186. So we are still able to profit $1.86, 186 bucks, if VST cooperates and stays between our two short strikes. And then if it doesn't, then, you know, that's a different story, and we're sort of in the Dell situation. So I'm not going to do anything. I'm going to let VST stay where it is. This VST trade is a lot more favorable than the Dell trade that we currently have going on. You know, in our Dell trade, it's well past the short strike of 125, well past our short strike of 110. That's a complete loser. And, I mean, the best we can hope for now is that Dell rallies. Hopefully it finds some stabilization there. And I'm not going to close it out just yet. I'm going to hang on a little bit longer just because we do have some good things working for us. Not going to be trading earnings, obviously, but let's take a look at the XBI inverted strangle that we have here. And this is another great example of an inverted strangle that is cooperating with us. And we've rolled this one to the moon and back. I opened this in March, this 92 put, and you can see the price action on this guy. 92 put. All the way down to 83.5, and that wasn't great. And now we have this inverted strangle, and it's gone all the way back up. So we were obligated to buy it as the stock ETF rather went down. We adjusted it, and now it's all the way back up, and we've got this inverted strangle that we've been rolling for a few months now. So so we've collected $950, and we are obligated to buy somebody's XBI, 100 shares of it, at 102 at a price higher than the market, and we're obligated to sell XBI we don't have, but that we would buy at 102. We're obligated to sell that XBI at 74 at a price lower than the market. So if we're buying higher than the market and selling lower than the market, buy high, sell low, that's terrible. The difference between 95 and 102 is 8. So that's an $800 loss. And then, of course, the credits we've received, we can add to that as potential gains. So we're going to lose $800 no matter what, but we collected $950 a share on 100 shares, which is $950. So $950 minus the $800 we're going to lose no matter what, is $150. So we can still profit $150, even if XBI stays anywhere between 94 and 102, which is not too bad considering we had a 92 short put and XBI went all over the place. XBI went all the way down to 81, you know, which is like $1,000 loss having to buy XBI at 92. So we defend, and then it goes all the way back up. So this one has just been a crazy ride that it looks like it's going to settle out okay. I'd be happy just getting back to zero on this trade, and sometimes you just have to prioritize your goals, right? With this trade, with all these inverted strangles, my goal is just to get back to even. VST, I'd be happy to just take my 800 and try again some other day. I'd be happy to do the same thing on Dell. I'd be more than happy if Dell just rallied in between these two short strikes and stayed there. This Dell trade, we have a lot of time on, so, you know, I'm happy to sit on that for a while, trying to scale into volatility and make something happen here, but yeah, we have a lot of exposure. So, you know, if Dell continues to go against us, we are probably rolling this guy out in time. I'm going to try to avoid earnings, though, like I said. And then, yeah, the rest of our portfolio, AMD down a few bucks. That 165 short call is looking nice. The NASDAQ down about 0.5%. And of course, we do have some short trades that are performing rather well today. Our Coinbase trade is up $84. Our ARM trade is up. Our Q trade is up. So we do have some hedges in the portfolio doing well. And then, of course, long Amazon, long CrowdStrike, long Palo Alto, and all those stocks are doing phenomenally. So we are just chilling. And I bet you if we look at the P&L, we're going to be up some amount today. Not a lot, but we're beating the NASDAQ, which is good. So that's sort of my lesson on inverted strangles. I know these tutorials are kind of all over the place, but it's my goal to just keep doing them. I'm getting a warning here in OBS that my stream may have suffered some quality, so I may have to adjust the bitrate on the next stream, but that's all for today's lesson, guys. Hopefully you learned something useful, and if you have any questions or, you know, stuff that doesn't make sense, feel free to DM me or tweet me at RealTraderJoe, Trader Joe Guru. I'll be around, and see you next time. Peace.